Welcome along, everyone, to the Squirrel webinar. Today, there'll be about 20 to 25 minutes of me presenting on a range of things, and then we'll get into some Q&A. 3 topics today. First of all, Squirrel On-Call Account, which we launched in January this year. I'll spend a moment talking about that. We'll talk about what's going on in the residential housing market. Then we'll move into what's going on in the Squirrel Investment Class portfolio and the metrics there. Righto, without further ado, let us begin. Squirrel On-Call Account. We're pretty excited to introduce this introduce interest onto this account in January. We've always had an on-call account, but we've not had the ability to pay interest up until January. So at 4% per annum, it's the highest returning no strings attached call account in the New Zealand market. And the reason we say no strings attached is so many of our savings and call accounts in New Zealand have strings attached. So we aimed to keep the product as simple as we possibly can. There is no tiering of the interest rates. There's no base and bonus saver type component. There are no fees and there are no minimum balances. And what's more, you can withdraw the money back to your bank account on business days within 2 hours. And if you make a deposit to us on business days, you'll also see that within 2 hours, which we think is pretty cool. Later this year, currently scheduled for sometime in May, the New Zealand banking system will move to 7 days. So from that point, you'll be able to pop money in and take money out 7 days a week, 365 days a year, between 9 a.m. and 10 p.m. each night, which we think is a pretty cool service. So that's coming in May. Between now and then, on business days, 2 hour turnaround. The fact that it's the highest paying no strings attached call account in the New Zealand market, we think is pretty cool. And we're glad that we're able to bring it. We know that the Reserve Banks certainly called out the banks for not having paid enough interest going back in time. So yeah, we think we're doing something to stimulate some competition in this space in the New Zealand market. And we've seen quite a bit of growth into that call account since we introduced the interest feature. Really important to understand that money invested or saved or money put in to be saved in the on-call account sits in a bank account at one of New Zealand's major banks. And that money is held on trust for you. It's not invested anywhere other than that bank account. The bank account pays us interest and we pass interest on to you. So that's how that works. And helps you understand the risk profile, which is obviously very low, given it's sitting with one of New Zealand's major banks. All right, there you go. There's our Squirrel On-Call account. So next up, I'm going to move on to the residential housing market and talk you through some of what Squirrel sees in that market. I'm leveraging a range of information from different people or different companies that are associated with the residential real estate market in New Zealand. So starting with, let's look at price changes over the 12-month period to the end of February. So this information comes from CoreLogic. Starting with the metros, you can see Wellington got hit pretty hard with prices off about 20%. There's a bit of variation between the different kind of suburbs and areas in Wellington, but broadly speaking, the 3 major areas of Wellington Central, Hutt Valley and Porirua were down around about 20%. With Kapiti Coast being down a little less. You can see the hit that the other centres have taken on that front. The provincial areas, so once again, looking at price change over the last 12 months, the end of February, you can see, there's a range from sort of down about 14, 15%, with Queenstown being at the opposite end of the scale, up about 10% over the last 12 months. I think what you're seeing there with Queenstown is the supply-demand equation. So lots of demand and not enough supply, and the classic economics 101. That's what happened to house prices in that situation. All right, keeping on trucking. I think one of the interesting things that Squirrel sees and is demonstrated pretty closely in this graph is as interest rates move, it really influences the number of property transactions in the market. So this is not about prices so much more about the number of transactions that occur. So the blue line in the graph represents the number of houses that sell in the residential space, and that's based off the left-hand axis. And the yellow line is where interest rates are at, and that's off the right-hand axis, but is inverted. So the higher the line, the lower the interest rate. The lower the line, the higher the interest rate. And you can see there's a pretty strong correlation between interest rates and turnover in the New Zealand market. Those lines are, really highly correlated over what is a, what have we got there, 14, 15-year series. I guess a couple of observations there. So we've seen some headlines in the last week or two, which say that this is the worst housing market that we've seen in 40 years. I'd probably believe it. And in actual fact, if you did it based on the number of houses that New Zealand actually has, or the number of dwellings that are available versus the number of sales, then I would suggest actually it's probably the worst that we've seen since probably World War II or very early 50s, way back then. Remembering that also during February and March, turnover will have been impacted by weather events in the top half of the North Island and along the east coast of the North Island. One observation from the last 2 or 3 weeks is our Squirrel mortgage advisors. So we have a pretty large team of mortgage advisors and represent about 3% of all buyers in the New Zealand market and helping them get finance. They are busier now than they've been for some time. So if we're an early signal of what's going on in the market, our mortgage advisors are all of a sudden getting quite busy, which probably says to me that property sellers are starting to become realistic about the prices that they're going to achieve for their property, and transactions are starting to happen. So perhaps what we've seen over the last, let's say 3 to 4 months is perhaps the low in the market, and transactions are going to start to tick up. That doesn't mean that prices are going to firm. It just means activity is starting to pick back up, which is probably a healthy sign for the market. And if I move on to the next slide, you'll see this graph shows what's happened for interest rates. I've used wholesale interest rates and borrowed this information from interest.co.nz. Thank you to them. So this is the 2-year wholesale interest rate, and this is what banks price their 2-year fixed rate loans off. If you look back over what is a 15 or so year period, you can see that interest rates are actually pretty high compared to where we've seen them since the GFC, up at around that sort of 5 and a bit level, if I describe it that way, and clearly having come off lows of that early COVID time. If we zoom in a bit tighter, this is the same information, but just what's happened to it over the last 6 months. So if you look back to October this year, you can see if you have a look at that orange dotted line that runs across the graph there, you can see that it looks like interest rates have probably reached about the top. They're not going to go too much higher from here because we've now seen 6 months of that 2-year wholesale rate actually holding in a range. Now that range is actually quite wide. It's wider than what we might have seen in past cycles from a New Zealand perspective. It's actually quite volatile, and it's probably a sign of the sorts of things you've seen in the market over the last 3 years. Lots of money's been pumped in, and all of a sudden inflation's got out of control and interest rates have been jacked up. Everything seems a lot more volatile than what it was pre-COVID. So that range is really wide. More than 75 basis points or 0.75% from peak to trough. If you look at that low that we saw in February and then the jump up that we saw in March, there's quite a wide range. However, if you look back over that 6-month period, chances are we might be near the top of where interest rates are going to be. If anyone's got a fantastic crystal ball out there and you have some better answers than I do, I'll be very happy to hear it. Okay, let's keep ourselves moving. So moving on to the Squirrel portfolio performance. Thought I'd start this part of the webinar today with things that Squirrel's proud of. So first of all, we've lent $375 million now in I've said life to date. So we opened our doors with our lending and investment business in 2015. And since then, that's the amount of money that we've actually lent. And there are no investor losses. Our active loan book today is around 125 million. So you can see that a whole lot of those loans that we've lent have clearly been paid back. We've paid $13.9 million worth of interest to investors over the 7 years that we've now been running. So that track record's starting to build. And I think it was around September or October. I think I celebrated the fact that we'd paid $10 million. So you can see that run rate on the amount of interest that we're paying to investors is really clicking up. And that's a couple of things. One, portfolio's growing. So we're seeing more investors, which means we make more loans. And interest rates are obviously moved up a bit. So both of those things are contributing to the fact that that we're seeing more interest being paid out to investors, which is a great thing. Our on-call account is market leading. Pretty proud of that. I won't rev it on because you've already heard me talk about that one. Our monthly income fund has a market leading return, and if you compare it against other retail mortgage funds in the New Zealand market. So I'll show you what that return is in a moment, but market leading return there, which we're pretty stoked about. Our term investment rates offer great risk adjusted returns. So if you look at the returns you're getting relative to the amount of investment risk that you take, then we would think you're getting a pretty damn good deal on that front. You're also helping borrowers meet the needs that they have for their residential property. So the work that you do in investing helps someone on the other side and helps get more houses built, for example, with construction loans, helps give homeowners more flexibility for our home loans, and the personal loans helps people do things that, whether it's renovate, buy a tiny home, or help some first home buyers get into their first home. Last but not least, you may have seen from us recently a whole series of blogs and some media work that, we've seen our CEO and our founder both been on TV in the last month or two. We've been on Radio New Zealand talking about the savings, the bank savings market and the way that things are working there. And we think things can be better. We think, if anything, homeowners with a loan are getting a great deal, and the savers and investors are actually not earning enough in the way that interest rates are set at the moment. So as interest rates have risen, banks haven't increased their savings rates as fast as they've increased their lending rates. You can see the blogs that we've written on the Squirrel website. So if you go to squirrel.co.nz, head to the blogs tab in the menu across the top there, and then if you go to the savings and investing area, you'll see the recent information that we've sent. You can also sign up to receive those blogs via email if you choose to, and I'm sure some of you already receive it. So there you go, a bit of a brag board. Hope that's okay, and you don't mind me talking about that. So where are our returns at the moment for the on-call account? 4% per annum. That money is clearly on call. Monthly income fund. So the information for managed funds is represented slightly differently. So the return for the month of February was 0.53%. If you annualize that, that comes out at 6.36% for the month of February, which we think is going great guns relative to where the market's paying. Our home loan investment class returning 6.75% per annum, which we think is a very strong value for money. Construction loan investment class at 7%, and then personal loans varying from 7.2% up to 7.5%. One of the questions that I got in this afternoon's webinar related to, are we likely to see the interest rates track upwards from here? The answer, while I don't have a crystal ball, would be I think we're at or near the top of where interest rates are going to get to. After the last official cash rate announcement from the Reserve Bank, which happened late February, no banks have moved their floating rates on the lending side, and only a couple of them have started to move some savings rates. Since then, despite the Reserve Bank putting up the OCR, we haven't seen a lot of movement, which would suggest to me that even if the Reserve Bank puts rates up again at their next meeting, which I think is next week from memory, maybe the week after, next couple of weeks, Whether they actually get any traction with it remains to be seen, because they haven't got any traction or very little traction with their last change. Righty-ho. So home loans and construction loans. For those of you who have listened to me chat on a webinar before, I've talked about the fact that we measure the credit risk in our portfolio each month. So what you're seeing here is almost 2 years worth of history for construction loans and for home loans. At webinars that I ran last year, I talked about the fact that we'd reduced our credit risk appetite for construction loans. And primarily that was reducing the loan to value ratio that we are happy to write loans at in various segments that we lend to. So you can see the decisions that we made in around May last year are starting to track through into the portfolio. So from running at about 65 basis points or 0.65% from May 21 through to May 22, we reduced the risk, our risk appetite. And you can see that that portfolio is now tracking closer to 40 basis points. So that's a 25 basis point move in credit risk and lowered the risk in the portfolio, which we think was appropriate based on what we've seen in the market. For home loans, you can see that risk appetite's remained the same right through that period. We're very comfortable with where we're writing loans at on that side, and that credit risk is running at sort of 10 to 12 basis points in that space. And keep moving on. Looking at our home loan investment class first. So the information that you can see across the top of the slide there, or the 5 boxes of numbers, that information comes straight from our website. And I clipped this off our website this morning. So this data, some of the data in here is updated on an hourly basis, and some of the data is updated monthly, but it gives you a sense of how the portfolio is performing. So the reserve fund for home loan investment class is growing really nicely. There's a really strong coverage ratio in place, so relative to the amount of credit risk that we're taking. So no particular issues on that front. And if you look at the amount that we're reserving, which is the number on the far right-hand side at 0.34%, compared to the amount of credit risk, which is 0.12%, you can see we're reserving at almost 3 times the amount of credit risk in the portfolio. So we think that's a pretty conservative approach. The one thing that I do keep an eye on is I'm not certain yet that the portfolio is large enough to consider it to be diversified. It needs to continue to grow. So the portfolio at around 16 million, in fact, it may have even, I think we've added a new loan in today. So it's probably up at 16.5 or thereabouts now. That portfolio just needs more runs on the boards, needs to get bigger before it becomes more diversified. And when I say diversified, that's the number of borrowers in the portfolio. It's also the geographic risk in the portfolio. So right now, there's a good spread of loans around different parts of the country, which is healthy, but we just need more of them. So the primary issue is just sheer volume of loans and growing. We have seen the number of investors putting money into home loans really start to grow in the last 2 to 3 months. So that portfolio is tracking up quite nicely at present. When Squirrel started the home loan, or all 3 of our investment classes, home loans, construction loans, and personal loans, the Squirrel effectively put money into the reserve funds to help seed them and make sure there was some money in there in the early days. So for the home loan investment class, Squirrel has made $100,000 available into that reserve fund just while it reaches maturity. That first 3 years expires this month, and we will continue to provide that 100K into that reserve fund until we start seeing some more diversification occur. So we think that's the right thing for us to do, is to continue to support that for investors. So home loans tracking along really well, no loans in arrears. I don't think there's any loans over term at this point. So yeah, things are tracking really well for home loans. Moving on now to construction loans, our construction loan investment class. So same information, once again, clipped from the website this morning. The reserve fund is growing really quite quickly for construction loans. We are reserving aggressively, so it's just over 3 times the amount of credit risk in the portfolio. So we're reserving at 1.24% versus expected credit losses of 0.4%. We think that's appropriate because this part of the portfolio is growing the fastest. So we're doing our best to ensure that the reserve fund keeps pace with the growth in the portfolio. And for those that have listened to me chat in the past, you'll know that we increased our reserving levels twice last year. So we were reserving at about 0.7%. We stepped that up to about 1%, and then we've stepped it up again to 1.24%. That's not because of the amount of risk. As you saw on the graph earlier, the amount of risk in that portfolio is actually reducing. What it is, it reflects the fact that the portfolio is growing really quickly, and the reserve fund grows slower because of the way that the loans work. So you add a new loan in for $1 million, for example, and the reserving kicks off a little bit incrementally each month from that point forward. So if all of a sudden you add $10 million worth of loans, the incremental growth in the reserve fund takes a while for it to catch up. Hence the fact that we're reserving aggressively in that space. I'd also say for our construction loans, that portfolio is well diversified across lots of borrowers now, a good range of credit risk and borrowers in there, and also well diversified from a geographic perspective. So there's around 100 loans in that portfolio now, which is fantastic. So that 100 loans creates diversity, and that gives me more comfort around the maturity of that reserve fund. In light of that, Squirrel's we're at the point where we think we're strong enough that Squirrel can remove the 100,000 facility that was made available to this reserve fund because of the diversification that's there and the sheer size of that reserve fund now. So looking at all of the stats, everything points to the fact that the reserve fund's ready to stand on its own 2 feet, just like the personal loan fund has done in the past. So yeah, really comfortable with where that construction loan investment class is. We put those decisions to the board to remove that support, and they were very supportive based on how the reserve fund's tracking and what we see happening in that portfolio over the next wee while. So that's information about our construction loan investment class. So moving on to personal loans now. The reserve fund is very mature and very stable with a really high coverage ratio. The expected default rate has fallen consistently over the last 3 years now, from around 1.2% down to 0.86%. Reserve levies were still reserving at almost twice the rate of the expected credit risk in that portfolio. And there's good diversification there. So there's around 400 loans in that particular part of the portfolio, good range of borrowers, geographically well diversified. And we've also reduced the amount of credit risk in that portfolio with a step in 2018 and then again in January 2022. So feeling very comfortable with where personal loans are at. Squirrel support, so the money that Squirrel had made available to the reserve fund was removed in 2021. So, we've been here and done this before in evaluating the strength of those reserve funds and how we see the portfolio tracking. So what we're going to do now is move into our Q&A session for the webinar. And I see there's some questions already in place. So let me start working on that. First question is from Graham. With the call account, any chance of high tax treatment? Good question. We'd have to do some creative thinking in order to put that in place. I won't say it's impossible, but we'll have to think about that a little deeper before we could make that available. So good point, Graham. It's something we've considered and something we could potentially do at some point in the future, but it's not on the drawing board today. Thanks, Graham. Next question from Peter. Who's the major New Zealand bank that the on-call money sits with? The answer to that is BNZ. Today, all that money sits with BNZ. At some point in the future, we may diversify and push and open bank accounts with other banks. just to make sure that we've got some diversification there. And it also helps us play one bank off against another around the interest rates that we're earning, which means that we may be able to look at doing something for investors if we're able to bargain our way up the curve as far as the amount of interest that we're earning. So yeah, today all of that money sits in a bank account with BNZ, and at some point in the future we may look to diversify it across other banks. We will not invest the money outside of New Zealand banks at this point, and if we were ever going to do anything outside of New Zealand banks, we would certainly be talking to you or making it as a separate option in some way if we thought there was enhanced returns but greater risk along the way. Thanks for that question, Peter. All right, next question from Glenn. How often is the return for on-call deposits reviewed, and would it likely to change anytime soon? So we're effectively passing on the interest that we get from the bank. So that interest rate is reviewed on a daily basis, or can be reviewed on a daily basis. It tends to change around the time that the OCR changes. If you recall back, when we first launched the on-call account, it launched at 3.50%, and we've subsequently moved it up to 4%. And that was 2 days after the OCR moved in late February. So we'll be quite responsive as interest rates both go up and as interest rates go down on our on-call account. Thanks, Glenn. Hopefully that answers your question there. Our next question is from Mike. Are you going to release this presentation as a recording? Yep, we sure will, Mike. We will take the Q&A session from the session we're doing now, and we'll also take the one from the webinar that I'll do tonight. Content is the same in both of those webinars. We'll stitch those together and we'll publish a link to all of our investors with this information. And I'd expect that will be done inside the next week or so. Thanks, Mike. Great to see these questions rolling through. Please do keep them going. I'm happy to answer them as we go. So, question from Catherine. Could you explain what needs to be done achieved for the home loan portfolio to be fully diversified? So from my perspective, it's really about size. I'd like to see that portfolio start getting up to 40 to 50 million. For that diversification to kick in. So diversification, in my mind, is a few things. So number one, the number of borrowers in the portfolio. Number two would be a good geographic spread of loans in the portfolio. Number three would be making sure that we're managing the credit risk, which I showed you on that graph earlier. And yeah, a good mix of different types of loans in there. So we don't want, lots of new builds in one development, for example, or anything like that. We want to see loans diversified around and across lots of different categories. And I would say we'd probably want to see that portfolio up around certainly 30 million, maybe as much as 40 million before I'd start feeling, at the point where Squirrel could remove the 100,000 that is tipped in to that reserve fund. So hopefully that answers the question, Catherine. If I haven't quite answered it, feel free to ask a follow-up on there. Hi, Robin. Question, KiwiSaver, can this also be transferred over? We don't have a KiwiSaver eligible fund available. If you have turned 65 and you're going to exit money out of your KiwiSaver, then the various Squirrel options are available to you, but you would need to remove it from your KiwiSaver to transfer it over. We have talked a little bit around whether Squirrel could offer something from a KiwiSaver perspective, and the conclusion we've drawn today is we don't think it would be useful for someone to put all of their KiwiSaver into what Squirrel does. You need more diversification than that. So there are some schemes in New Zealand that allow people to self-select, and where people are able to self-select and perhaps park a portion of their money into the Squirrel monthly income fund, then that may be an option at some point in the future. At the moment, we don't have that on the drawing board, but it's something we've kicked around a little bit to understand how that might work. Thanks, Robin. Great question. Question from Jared. Will Squirrel ever go public? Good question, Jared. It's something that has been discussed at various stages in the past. So today, Squirrel has roughly 180 shareholders, and the vast majority of those shareholders arrived through a crowd raise that was done in 2016. If you're interested in buying shares, you can either hit me up at dave@squirrel.co.nz, and if there are people willing to sell, then you may be able to buy some. Or you can try investor@squirrel.co.nz. If you email either of those two addresses, and we'll look after you there, Jared. So at the moment, Squirrel is not a publicly traded, or doesn't have publicly traded shares. They're effectively traded privately. Thanks, Jared. Question from Kerry. Can you tidy up construction loans so I have larger loans rather than in my 12 loans, small amounts from $84 all the way up to $90,000? I guess that's one of the, I guess both the pluses and the negatives of bringing our minimum investment down to $100. So by bringing it down, it does mean from time to time, you may have some really small amounts of investments. And it can feel untidy as a consequence. So I understand your concerns there, Kerry. One of the options you do have if you want to keep things really clean would be to invest via the Squirrel Monthly Income Fund. That means you effectively have just one investment, and you can add to it. So you can kind of add to one individual investment and withdraw from that individual investment. So it works a bit differently from the way that our term investments work. And that would be the tidiest way to go. If that was important to you, it also means you just end up with one interest payment each month, which you can elect to have either paid back to your bank account or capitalized onto your investment. For the term investments, the only easy way to try and perhaps sell small investments is to put them on the secondary market, collect up money until you've got an amount that you're comfortable to reinvest, and then reinvest it. So that's the only way to do that today, unfortunately, Kerry. If you have questions about the monthly income fund and how that can work for you, feel free to hit me up on dave@squirrel.co.nz, and I can pick up any specific questions for you there. Next question, where does the reserve fund come from? From investors' money. So the way that this works is when a borrower makes a repayment on their loan. So let's say it's the 29th of March and the borrower makes their normal monthly loan payment. When they make that payment, let's say the payment is at their interest rate of, I'll just make a number up, at 9%. So that's the amount of interest that they're paying. So they make their payment at 9%. When Squirrel receives that payment, we split it up into three portions. A portion goes off to the reserve fund, and we call that the reserve levy. So if you recall back to those this information that I'm just displaying on the screen here. So for personal loans, this borrower reserve levy you can see is 1.51%. So let's say the borrower was paying 9%. We would deduct 1.51% if it was a personal loan and push that off to the reserve fund. Squirrel would take its margin, and that margin can vary depending on the nature of the loan, but on average works out at about 1.3%. And then, so we've deducted our margin, and then the remainder of that interest payment will go off to you, the investor, as your return. So if I make the numbers really easy, let's say the borrower is paying 9%, we'll deduct a 1% levy, we'll deduct a 1% margin, and that leaves 7% for the investor. So that's how the reserve funds, that's how they grow each month. The money in the reserve fund sits in a bank account, also with BNZ. and earns interest. So that interest payment obviously tips itself in each month as well. Where a borrower is paying default interest, then that default interest will also tip into the reserve fund. Okay, that was a good question. Happy to take any further questions on that front if I haven't quite captured what you're looking for there. Let me just read this one. So what happens when you lend under the personal loan and Squirrel is a second tier lender, first tier being the first mortgage issuer? All right. So Graham, I'm going to use our Launchpad loans as an example here. So Launchpad loans, our Squirrel advisors will be chatting with a first-home buyer, typically a high-income first-home buyer. They might be taking out in total a loan that works out at 90% LVR. So let's use that as our example. So let's say it's $1 million loan with a 90% LVR. What we do is $800,000 of that loan is funded as a first mortgage by a non-bank in New Zealand known as Resimac. Then the 100,000, so the difference between the 800,000 and the 900,000 that the borrower needed, is written as a personal loan, and we have a second mortgage on that portion. Okay, so first mortgagor is Resimac so they have a first mortgage, and then Squirrel has a second mortgage on that 100,000. So what happens in the event that the borrower defaults on their loan? All right, so they bought the house for $1 million, and we're 2 years down the track, let's say, and they need to sell the house. Now, obviously, the house price could have gone up or down. If we use the current environment as an example, the house price will have gone down. And let's say the house price has fallen to, let's say 900,000. I'll try and keep the maths as simple as I can for me. So a mortgagee sale is conducted, and the house sells for $900,000. So in the 2 years that the loan's been live, the $800,000 first mortgage loan, that's on interest-only terms, so that stayed exactly where it is, and it's still $800,000. The personal loan for $100,000, that's been paid down. So the borrower is making both principal and interest payments on that. And let's say after 2 years of 5, they've paid that down to, I'm making the number up, let's say they've paid that down to $70,000. Okay, so the borrower currently owes $870,000, and the house is sold for $900,000. In that situation, there would be some legal costs to do with the mortgagee situation, and there would also be some costs, real estate agent costs, to sell that property. So let's say it costs $50,000. I'm making the number up for real estate agent fees plus the legal fees, and then maybe there's some other things. Maybe the lawns needed to be mowed, and maybe the house needed to be tidied up before it was sold. So let's say in total there was about $50,000 worth of costs. So sold for $900,000, $850,000 was returned. The borrower had total outstanding debt of $870,000. So there's a $20,000 loss in that situation, which the reserve fund would absorb. So the balance of that reserve fund, so using the information that's on the screen, the personal loan reserve fund has got $830,000 in it. On the day that settlement occurred on that property, that would drop to $810,000. The $20,000 difference is still owed by the borrower. So Squirrel would follow that borrower up, perhaps using a debt collection agency to try and recover that $20,000 in addition that's owed. On the assumption that we're successful in claiming some of that money back, then that money would be tipped back into the reserve fund when it's returned. All right. So Graham, that was a long answer to your question. And happy to take any further questions as we go on that. And hopefully you managed to follow along there. Thank you for that one. All right, next one. How many personal loans are there where Squirrel is the second tier issuer? There are a lot. So if we think about a personal loan and the amount of security that you have, broadly speaking, so I'm going to use round numbers, there are about 90% of the value of the personal loans is secured, okay? And the second part to that answer is then, well, if it's secured, what is it secured over? So that security could be a caveat on the title of a house. So a caveat is not as strong as a first mortgage, and it's not as strong as a second mortgage, but they give us some power at the point at which a house is going to be sold. Okay. It could also be we have security over a tiny home. So we lend on tiny homes. So that tiny home we can go and pick up and resell if we needed to, if the borrower had defaulted on their loan. Or it could be a second mortgage, which would be the example that I gave before. So for our personal loans, security, about 90% of the loans are secured, and that security could be caveat, could be security via the PPSR on a tiny home, or it could be security or a second mortgage as security. For all of our home loans and all of our construction loans, there is a first mortgage in place. Okay, so the security that we have on our home loans and our construction loans are first mortgages, and that's really strong security. It doesn't really get any better than that, really. Hopefully that answers your questions there. Thank you. All right. Once the construction reserve fund has increased a bit more, is the intention to reduce the percentage going into the reserve fund, have that percentage going back to investors? Yep. So Dave, we'll keep that under watch over time, and as that reserve fund gets to the point where we think it's really mature, then we will review the reserve levy. My gut, based on where we're at today, the earliest we would be looking to do that is probably the end of this year. So we'll keep that under review. I look at that information and report that through to our board every month. So yeah, we keep a really close eye on that, and we'll continue to review it. The earliest I suspect we would make any moves to reduce the amount that we're reserving would be the end of 2023. That's my view at this point. Lots can change, so we'll keep a watching brief on that one. Thanks, Dave. Is there an option to set up a second call account as a savings type account for kids? We have thought about that. Once again, we've kicked ideas around. As you can tell, I've talked about that 3 or 4 times today. So you've all got some fantastic ideas, and thanks for sending those through. We have kicked it around. There is an option there. It takes quite a bit of work for us to get that done. We're actually kicking around a few ideas in that space at the moment. And I'd expect perhaps later this year, we'll start to see some movement. Whether we do this for kids or not, that's not a definite yes, but it is something that we are thinking about. All right. It is probably worth pointing out, Ruby, that you can set up an account for your kids in the monthly income fund. So if you're comfortable with your kids investing in the monthly income fund, then you can set up accounts for your children there. At the moment, the peer-to-peer legislation prevents us from setting up accounts for people under the age of 18 to invest in term investments. But we don't think it stops us from setting something up so they can put money away as a savings account. So the monthly income fund might be an option for you, for any of our investors who are thinking about setting up an option for their kids. Hopefully that works there for you, Ruby. Thank you for that one. The personal loan category doesn't seem to have increased along with interest rate rises like the construction loans have. Are there any plans to raise the rates? So I guess a couple of answers to that question. So for our home loans and our construction loans, they're on variable interest rates. So that means that when interest rates are moving in the market, we push interest rates up for borrowers, and we also pass on then those increases for our investors. For personal loans, they're offered on fixed interest rates. Okay, so that means that the borrower, or for existing loans, is on the fixed rate, and it also means as an investor, you're on a fixed rate in relation to that particular loan. If we go back to the start of the interest rate cycle, our 1 year and 2 to 3 year term investments for personal loans had a return of 6 and 6.5% respectively. So today, those interest rates have gone up twice and are now at 7.20%. We have not moved the 5 to 7 year rate. That's still remained at 7.50%. If you recall on this page that you can see live on the screen at the moment, I talked about the fact that we reduced the amount of interest rate risk that we were taking in 2018 and again at the beginning of 2022. So the amount of risk in that portfolio has dropped, and therefore the type of borrowers that we're attracting mean that we can't push our interest rates up quite as easily. So the 5 to 7 year rate at 7.5%. It's possible that may go up if interest rates continue to rise in the market. Equally, the 1 and 2 year rates may also go up from here, but they're probably nearing the top of what we believe we can charge borrowers on that side, and therefore that's how it plays out on the investor side. What I also see is continuing to have lots of demand from investors for those interest rates. And if you think about the way fixed interest rates work, if indeed we are at the top of the interest rate cycle, then it's probably a good time to take a small portion of personal loans because you're going to lock in at the top of the interest rate cycle. Clearly, none of that's guaranteed, and I'm not giving advice, but yeah, something to think about there. So as it stands at the moment, there's no plan to increase the interest rates on personal loans. However, we'll continue to monitor what happens in the market, and it could be that they do push up slightly further from where they are now, but I don't expect they're going to be rising by 1 or 2%. They're going to be rising maybe 0.5%, if that, through this cycle, based on what we know today. Thanks, Alexandra. All right. Very good. Thanks, Robin, for your comment there. If you have any feedback, feel free to fire that through on dave@squirrel.co.nz. This is the last question in the queue, so I'll answer this one in just a second. Along the way, though, if you have other particular questions or you want to give me feedback, either you can pop it in the chat or Q&A boxes in the webinar, or you can give that feedback to me directly on dave@squirrel.co.nz. So if you've liked what I've talked about today, then that's great. Give me some feedback on that. If you haven't liked it or wanted to hear something different, feel free to give me feedback on that as well. On dave@squirrel.co.nz. All right, on to the last question. Thanks for this one, Chris. I'm happy to stay on if there are further questions that come through. With the fall in house market prices, have you seen a corresponding increase in default, interest situations, and mortgagee sales? I think what we have seen, Chris, in the portfolio, and we publish information on our website about this. So we publish the number of loans that are in arrears, the number of loans that are over term. So that's the loan is due to be paid back, let's say on the 1st of March, and it hasn't yet been paid back for whatever reason. What we've seen most often, so we've seen the odd loan has gone into arrears for home loans and construction loans. Or when I say arrears, they've missed a payment. The vast majority have caught up on those within 7 days. So technically, the arrears would mean the 30 days since the payment that they missed that they haven't caught up on. But yeah, so typically it's a missed payment. They miss it by a day or two, and often it's administrative issue on the borrower side rather than an underlying financial issue. From an over-term perspective, often we've seen that happen quite a lot in the construction loan investment class. And the reason for it is construction's been delayed. So we've seen all sorts of delays, whether it's councils being slow, materials being difficult to get hold of. So some of those construction projects have just simply taken longer to get done. Sometimes we'll roll the loan over. So we'll write a term extension, pay out the investors and extend that loan for a 6 month period to help the borrower get through that project. And that will start as a new loan. And sometimes we're finding that a loan will run maybe 3 or 4 weeks past its due date. In that situation, it may just sit in a default state for 3 or 4 weeks, and the borrower pays default interest, which will tip into the reserve fund at that point. But yeah, we're clear of, in those situations, we're typically clear as to how long it's going to take, and that will help form the decision on how we approach that particular borrower. In the market, are there more mortgagee sales going on? I haven't seen a lot, to be fair, and it's probably too early in the cycle for it to really start coming through. I'd expect that you'll start to see that probably over the next 6 months. So if you kind of start now and you look at what happens to mortgagee sales in the market over the next 6 months, that's where you'll start to see that kick in. And that's because a lot of borrowers are rolling off fixed rates in the market. And I'm talking generally here, Chris, about the market, which I think is where your question is pitched. It's probably just at the very start of that cycle of where you might see a mortgagee sale start to flow through. It can take a while after interest rates have risen and after the unemployment rate starts to rise for that mortgagee sale situation to kick in. As it stands at the moment, the unemployment rate has continued to be stubbornly low, if I use the Reserve Bank's terms. And, if you've got income coming in, the last bill that you don't pay is your home loan. So, people hang on as much as they possibly can to make sure they make those mortgage payments over time. Is the 100,000 that Squirrel has included in the reserve fund value shown? The answer is yes. So you can, the values in the reserve funds, and if I scroll back on the pages. So for personal loans, so for the construction loans, currently the 821,000 includes the 100,000 that Squirrel makes available. You'll see that removed on the 31st of March. And for home loans, 191,000, 100,000 of that is money that Squirrel's made available to that reserve fund. So that answers that question. Thank you for that one, and a great question, Nakachit. All right. I think I had about 15 to 20 questions from this afternoon session. So there's your challenge, team. Chris, next question's popped up from Christopher. You generally seem to have more funds than people needing funds. Is this correct? I think the balance between supply and demand varies across the three portfolios. So for home loans and for construction loans, Squirrel has quite a number of loans, we'll call it in stock. So if I talk like a retailer, we've already drawn a range of home loans and construction loans, and as there is investor demand, we feed those into the market. We have probably around 15 to 18 million of loans in stock between home loans and construction loans, and we just feed those in as we go. There's a different supply-demand balance for personal loans. So for personal loans, we have more investor demand than we have loans available to provide. So as soon as there's a loan available, it gets fed straight into the market for investors to invest in. We've talked about the fact that we've reduced our risk profile over the last few years for personal loans. That has had an impact in the number of loans we're able to originate. But based on where the economy is going and where potential unemployment rates are going, we feel very comfortable with the decisions that we've made. So it does mean that as an investor, if you're investing in personal loans, you do need to wait in a queue. You will now be earning 4% per annum while you're waiting in that queue, which we think is a reasonable trade-off. And given that the personal loans are on fixed rates and we're now what we believe to be at the top or near the top of the interest rate cycle, it's probably not a bad bet to invest in some personal loans. So you can kind of, assuming interest rates run off, you'll hold your returns up at that point. Home loans and construction loans are on variable rates. So yeah, different supply-demand balance across each of the different investment classes. Home loans and construction loans, we have lots of loans available, so you can keep investing as you wish. For personal loans, always a bit harder for us to originate lots of personal loans based on the risk that we're happy to take. Thanks for that question, Christopher. All right, answering the next question from Ken, could you please give a quick overview of the monthly income fund? Sure thing. So Squirrel's monthly income fund is a managed fund. You can invest in that managed fund, and then Squirrel manages the investments. All of the money that's placed into the monthly income fund is invested in home loans, construction loans, and personal loans. there's a lid on the amount of personal loans that we'll have in that portfolio. So it's predominantly home loans and construction loans. It's probably a more passive way of investing, I think, Ken, would be the best way to describe it. So money's put in. As an investor, you can add more money as you see fit. You can also withdraw money with 30-day notice period applying. And you are paid a return on a monthly basis. So about the 10th working day after each month, your return either is paid out to you or it is capitalized. So you can capitalize your growth in there. So it's kind of a set and forget type situation. You can pop your money in, it'll just capitalize away or pay out to you on a monthly basis, which does what it says on the tin, which is monthly income fund, funnily enough. You can read lots about the monthly income fund and reports on how it's performing, for example, on the Squirrel website. So if you go to squirrel.co.nz, hit the save and invest tab at the top. In that menu, out to the right-hand side, you'll see the monthly income fund. So that suits investors who want to be a bit hands-off with their investing, like the risk profile. You can pop some money in, you get a return once a month, and yeah, does what it says it's going to do. And all of that money is invested into one of the 3 Squirrel investment classes. We don't invest it outside of that. Thanks, Ken. Next question from Glenn. Are people borrowing home loans not borrowing from banks because they don't fit bank criteria? I think the simple answer to that, Glenn, is yes. The more complicated answer is just because they don't fit the bank criteria doesn't mean they're a bad borrower. Bank credit policy is notoriously a blunt instrument. So because it's such a blunt instrument, the banks leave a range of niches that are available for others to provide products into. So that's what Squirrel's done. We've identified some niches. So an example of that would be people who are aged sort of 55 to 65, looking for some flexibility around their borrowing. The banks at that point are demanding that they make principal and interest payments, despite the fact that the borrower may have a huge amount of equity in their property. So in that situation, Squirrel's happy to lend, perhaps on interest-only terms, or if it's short-term, on interest capitalizing terms, so the borrower can effectively leverage some of that equity in their property. Often we find someone might be planning on selling their house in 2 to 3 years' time in downtown Auckland, let's say, or in a reasonable suburb of Auckland, and they're looking to move to back to the provinces somewhere or to downsize, and this allows them to create a bit more flexibility in their cash flow between now and when they sell the house. It might mean they do a bit of renovation work on the property or do something to try and enhance the value of it in the meantime. Also, from a construction loans perspective, maximum loan size there for us is 2 million. And we know that banks don't do a great job of lending to good quality builders who are in that sub $2 million loan range. They make it really hard for borrowers in that space. So from a Squirrel perspective, there's another little niche there. And if you take a niche in the personal loan space, then tiny homes, banks don't do a great job lending there. Yet we've found that portfolio performs incredibly well for us over what's a 4 or 5 year period now that we've been lending on tiny homes. Hopefully that answers your question there, Glenn. Thank you for that. Feel free to follow up with another one if I didn't quite capture the essence of it. All right, next question. Is the on-call account completely risk-free as it does not have a reserve fund? Well, because the money sits in a bank account at one of New Zealand's major banks, it's with BNZ. So I had that question this morning, so I may as well let you know. So really, if you think about the investment risk, if you're comfortable putting money into a bank account with BNZ, then that's your risk profile. The money is held on trust for you, so it's you're not giving it to Squirrel, so to speak. It's not Squirrel's money. It's your money held on trust in a bank account at BNZ. So no investment is ever risk-free. And could BNZ fall over tomorrow? Well, it could happen. Pretty unlikely though, because they're very well regulated in New Zealand. And yeah, banks are in very good shape. So from that perspective, we don't believe there's any reserve fund or anything like that required. as the amount of money in that call account grows, we may open bank accounts at other banks and try and apply some pressure to improve the interest rates over time that we get. So the faster that grows, the faster we'll be able to try and apply some pressure to try and improve the interest rates further from what we get today. And by spreading around other banks, obviously we're starting to manage the investment risk there. Thanks for that question. You're on a roll now, team. Good work. I'm just going to take a sip of water. All right. Our next question is from Steph. So can you tell us a little about Launchpad for first-time homebuyers? Sure can. So best to demonstrate this as an example. One of the niches that we've identified is that if you're a high household income first home buyer saving towards a home, you're put in the pot with everyone else where you need to grow a pretty big deposit to get you there. When in actual fact, if you've got really strong household income and are expected to continue to have strong household income, then actually maybe you should be able to buy a bit sooner than that and try and pay that loan down quite quickly. So Squirrel's devised a product. Let's say the borrower, you've got a couple. They're both on PAYE income, so they're both employed earning salary or wages. Typically, they'll be earning $150,000 a year or more as a household. I'll just use an example. So let's say it's they're going to buy a house for $1 million. Keep the numbers nice and round to make life easy for me. They've saved $100,000, and so they need a $900,000 loan. So Squirrel has worked with a company by the name of Resimac, who are a non-bank loan provider in New Zealand. They will take the first mortgage and provide $800,000 of the $900,000 that the borrower needs. The other $100,000, Squirrel will write as a personal loan and will take a second mortgage on the property for that $100,000. The $800,000 from Resimac is on interest-only terms for 5 years, and the personal loan is on principal and interest payments for 5 years. And that part of the loan is more expensive, so the borrower is going to be paying 9.95% currently. And so they're incented to pay that down as quickly as they can. So in that situation, that's a second mortgage. And so for Squirrel, that $100,000 is placed as a personal loan in the portfolio. And that borrower is able to start paying the loan down rather than trying to save and paying tax on their savings and having to pay rent at the same time. So all those things compound. And we know higher household income borrowers aren't eligible for the first home buyer schemes that are available through government, for example, the first home scheme. Steph, hopefully that answers the question for you. If I didn't capture all of what you were looking for, feel free to pop a follow-up in there. All right, thanks, Edward, for the next question. If a borrower refinances a loan, is the collateral that has been used for the original term been revalued to take account of any possible drop in value? So yes, so when we refinance a loan, we will reevaluate the loan, or when we're looking at that loan, we'll gauge the value of that property at the time. For home loans and for construction loans, the absolute maximum LVR that we go to is 80%. And depending on the borrower, type of borrower, all those sorts of things, chances are it'll be less than 80%. On average, for the home loan portfolio, the LVR, or loan to value ratio, for home loans is at a portfolio level is running at around 60%. And for construction loans, it's running at about 63%. Okay, so there is a lot of equity sitting in front of those loans. So, we've seen property prices come off 20% in Wellington over the last 12 months. Actually, on average in the portfolio, there's still lots of equity there against those loans. So thanks for that question, Edward. Hopefully I've captured that, and feel free to ask a follow-up question if there's further information you're looking for there. Next question, future ideas and plans for new products. So we've got a number of ideas of different things that we want to do. We're making a range of changes at the moment, which won't be new products, but makes life easier for new investors who register. So we're progressively rolling that out over the next 3 or 4 weeks. So as an existing investor, you won't get a lot of benefit out of that, except we've just made it easier for new investors to join. So that means the portfolio can grow faster. We are toying with a few different products in a few different spaces. And I suspect you'll see some new bits and bobs from us come out during the course of this year. That's probably all I'll reveal at this point, Christopher, but thanks for the question. We tend not to sit on our laurels here at Squirrel. For any of you who've worked with us for a while, you'll know that we're always doing new things and got enhancements rolling out. Question from Rory. Any thoughts on a higher risk, higher return fund? Yes, that's one of the new product areas that we're looking at. We are tussling with the question about who we think should be able to invest in that fund. So do we make that one open to retail investors? Or do we only make it open to wholesale investors? Because if we take more risk, and we don't have the protection of the reserve funds, then that credit risk is quite real. And so we're thinking quite hard about things in that space. And we may only consider allowing wholesale investors in, given we don't want to feel like we're putting investors' money at high risk unless they understand the risks that they're taking. So it's a really fine line there between, we could make a higher risk fund available to all investors, but we need to make sure that people truly understand what they're investing in if they're taking higher risks. So for the home loans, construction loans, and personal loans, I feel I can sleep very comfortably at night presenting those to everyday investors who may have varying degrees of knowledge. Reserve funds do a great job of acting as a stabilizer and helping manage that credit risk. But once we start taking on more risk with a higher return fund, we might be able to produce a 9 or a 10% return on a regular basis, but the credit risk that's being taken is absolutely higher. And so anyone going into that would need to make sure they've really understood and done their homework around what they do, which is why we're really thinking quite hard about the eligibility criteria for coming into that fund. So that is one of the new product ideas that we're considering. We already write some loans in that space today, and we have wholesale investors funding them. If you have interest in that, Rory, perhaps drop me an email on dave@squirrel.co.nz, and happy to chat to you on a one-on-one basis in a bit more detail on that. Thanks for that, Rory. Question from Andrew. So why can't the call account return be closer to the OCR? Okay, so let's talk through how that works. So we receive an interest rate from BNZ. We take a small margin ourselves, and then we pass on the vast majority of that interest to you, the investor. So the margin that we take covers our costs of providing that account. So, we've got fees to pay with BNZ, and we've obviously got costs associated with running that call account. So we take a small margin there, and we don't receive the official cash rate. Okay, so we're not earning at the official cash rate level. BNZ take a slice before they pay us. So so that's the answer to that one, Andrew. Very straight up and transparent. That's the way that we like to operate here at Squirrel. Thank you for that. Looks like a follow-up here question from Lance. Is the monthly income fund a high tax fund? It sure is. So, yep. So for the monthly income fund, there is high tax payable compared to our term investments and call account returns, which will be resident withholding tax. So if you're a higher income earner, then you may find your after-tax return might be better with the monthly income fund rather than investing in the term investments. Thanks for that question, Lance. All right, you guys are doing a great job of asking questions. Well done. Thanks for your feedback there, Glenn. tax on the call account would be great sometime. Funnily enough, I had that same observation this morning. We'll have a think about that one. That's one of the potential product ideas that we can kick around. That doesn't mean it's easy to provide. We know the banks do provide that today, or some of the banks do provide a call fund, so to speak. Mixing my products up there. But yeah, so that's something that we'll think about in time. Thanks, Glenn. Next question is from David. So how does Squirrel make its money and how stable is the company? All right, so let's talk about Squirrel. There are two main parts to the Squirrel company. We have a very large team of mortgage advisors who are spread mostly in Auckland and Wellington. So there's about 70 people, or it's about 100 people, a bit over 100 people in the Squirrel company. We've got about 65 to 70 people who are involved in providing mortgage advice and supporting that part of our business. And then the remaining 30 or so, or 35 people are our head office team, and then the team that runs the Squirrel Money business. So those are the two parts to the business. The Squirrel Money business, if I focus on that part of it, so it's a separate entity, it's a profitable entity. So it actually makes money. So that's a good thing. It's grown from the point of being very small and not making money to the point at which, or with the support of the wider Squirrel group, I should say. So, the fact that it wasn't making a profit, it had that support. So that kept the business growing and moving. It's now tipped over into the point of being profitable, which we think is a really good and healthy thing. And it's just a sign of the growth that we've had in the portfolio over time. As a company, Squirrel started as a one-man band in 2008, and now over 100 people. Revenue for the financial year that's coming to a close will be around about 20 million, and that contrasts with revenue being about 16 million at the end of the last financial year. So if I look at Squirrel's prospects, we're actively growing our market share on the mortgage advice in the mortgage advice market. So that's grown from, sort of 2 to 2.5% up to over 3% now of the market. And I think that's testament to the strength of the Squirrel brand in the market and the money that's been invested in that space. So we make money from providing mortgage advice. So we earn revenue from the banks from supporting them with providing mortgage advice for the customers that are brokered to them. I would also point out that our Squirrel mortgage advisors, the vast majority are on a salary. They do earn an incentive, but they're not incentivized to place business with any particular lender. So we think that's a good model to operate there. And that's the biggest part of our business. The Squirrel Money business, we take a margin. So we earn a margin and we do earn some fees along the way. And that's how that part of our business is growing. Our Squirrel Group financials are published on the Disclose website, so you can always go and check those out from the last few years. And new financials will be published, I think it's at the end of July, from memory, for the financial year that we're about to finish at the end of this month. All of our financials are audited by KPMG each year. In addition, KPMG perform a custodial audit for us. So that custodial audit, so Squirrel Money or Squirrel Peer-to-Peer Trustees and the Squirrel Money business is a custodian of your money as an investor. So we, KPMG come in and they review our systems and processes and technology to make sure that we're doing the right things by investors. And those reports are passed on to the Financial Markets Authority, who are our regulators. So that's Squirrel, the company. Probably the other thing is there are around 180 to 200 shareholders in Squirrel. Most of those arrived during a crowd raise that occurred in 2016. So that's our kind of corporate structure. Hope that was a long-winded answer, David. Hope that works all right for you there. If you have follow-up questions, feel free to ask in the Q&A box, or you can always email me on dave@squirrel.co.nz, and happy to take any other questions there. Hi, Nick. Good to hear from you. Are construction loans typically first or second mortgage? The home loans and construction loans all have a first mortgage in place. Okay, so home loans and construction loans, first mortgages, which is the strongest form of security we can take. For personal loans, the security varies. So personal loans will vary. It could be a caveat on the title of the property, could be a second mortgage, it could be a registration through PPSR in the case of a car or a tiny home. But for construction loans and for home loans, always a first mortgage in place. It's part of the credit criteria for lending in that space. Thanks, Nate. Hi, Andy. Will the questions and answers be posted somewhere on your website? So what we will do is we're recording today's webinar and we recorded this afternoon's one. We'll stitch those together, particularly the Q&A section, and we will post all investors out a link to be able to go and review the webinar and hear me chatting through the answers. Yeah, so you'll get the Q&As posted that way or through the video. So feel free to have a look at that once we send it through. I'd imagine that video will be out within about 7 days, so early next week. Thanks, Andy. Righty-ho. Glenn, looks like you're an investor with Harmony, earning 15% returns, but it had to have risks. A real return was about 11. Yeah, good questions there, Glenn. Personal loans is an interesting one. There is opportunities to make money in that space, but the risks are real, as you point out. So, a 4% credit loss from, starting at a 15% return and the real return ended up at 11%. It's a pretty big risk to take. And if you think about the last, I don't know, let's say 5, 6, 7 years, we've seen the unemployment rate probably falling the bulk of that time. Obviously, there's that early COVID period where things went a little haywire, but generally speaking, the economy's been performing really strongly. If we genuinely do go into a proper recession over the next year or two, as the Reserve Bank has forecast, and the unemployment rate starts tracking upwards, then the real returns that you would have got had you been able to continue investing in Harmony may have taken a bit of a hit at that point. So there's a real risk-reward trade-off there. We think there are opportunities in different parts of the markets rather than personal loans to generate better returns and probably with better security compared to personal loans. So yeah, probably the growth areas that I think Squirrel would offer are more mortgage-based rather than personal loans. Thanks, Glenn. Hopefully that answers your question there. Right, question from Sol. Are you going to support deposits withdrawals from third-party apps in the future? So, for example, the Wise app. Right now, the answer is no. We, from an anti-money laundering perspective, while 99.999% of our population are good actors, we know that there are a handful of bad actors out there, and so we're pretty tight in our anti-money laundering approach. I can't see us making the ability to withdraw to a Wise or some other third party available in the near future. It'll be to a New Zealand bank account, I would suggest. So that's not something on our drawing board at this point. And I don't think it would be in the near future, or, and perhaps even the medium term. Once the rules around the consumer data right come into play, then that market starts to become a bit more regulated in the way that things operate. So, there's some stuff that we're thinking through in that space once consumer data right, or open banking. You might also have heard of it as open banking rather than consumer data right, once that actually arrives. But we're probably talking 2 to 3 years before anything real happens in that space, based on the fact there's lots of legislation that needs to come through first. Thanks for that question there, Sol. Next question, would you have a pie managed fund for each portfolio with access to the reserve fund? Good question, Nick. Sitting behind the monthly income fund today, we actually have 3 wholesale funds. We make those available to wholesale investors. We could potentially make them available directly to retail investors at some point. We haven't opted to do that at this stage. It does come at a much higher cost. So, while you would get the benefits of PI tax being payable on those funds, the amount of fees, like managed funds, are expensive things to run. Let me put it that way. So we'd need to make sure the fees covered our costs and the ultimate outcome made it worthwhile for investors. So that is one of the things we've previously kicked around. And it's something that's, an idea at this point, but there is no firm plan around it. So yeah, something for us to think about there. Thanks for that question, Nick. All right. Last one was a thanks from David. So I appreciate that, David. That looks like we're coming to the end of our questions. I'm happy to stay on and answer some more questions. We've been going almost an hour, so you've done a fantastic job, up to 22 questions. Well done, team. I think you've beat the team this morning, or this afternoon, sorry. Hopefully you've found that of value. If you have feedback for me on what you've seen and heard here, then feel free to give me feedback on dave@squirrel.co.nz. You can email me on that. If you've got feedback on things you'd like to hear different, then feel free to rip it through to me. A couple of other questions have popped through, so if you want to keep listening, then I'll carry on with those ones. All right, can anyone invest in Squirrel shares? The answer is yes. So if you have an interest in that space, if you drop an email through to me, dave@squirrel.co.nz, there is a private marketplace where shares trade hands. It's not a very liquid marketplace, so they're not, you can't see Squirrel listed on the NZX or anything like that. Maybe that will happen one day, but we're not there at this point. But yes, shares do change hands between those, between investors in that space, and you can buy shares. So Glenn, if you're interested, send me an email on dave@squirrel.co.nz and I'll hook you up on that front. Thanks for that one. Question from Josh: is it likely the number of construction loans will continue to rise based on recent weather events such as those in Napier and Gisborne furthermore in the future? Yeah, I would say so, Josh. There seems to be an unending demand in the niche that Squirrel plays in. The reason is that competitors don't do a great job in this particular segment of the market. About between 60 and 70% of our loans for the construction space are written in Auckland. The rest are spread around all different parts of the country. Interestingly, we didn't have any consequential weather impacts on any of the loans or projects that were funded through that weather, which was, almost surprising given the number of them that we have. You would have thought we would have had some consequential impact somewhere, but no. Having worked with, checked in with all the borrowers on that front. So actually we've come off pretty lightly on that front. But yes, you will continue to, New Zealand still has a shortage of houses, believe it or not. So if you look at all of the stats, while we're getting closer towards balance, we're not there yet. So we still need to build more houses. And if we keep the immigration taps turned on, we still need to keep building more houses. So don't see that going away anywhere anytime soon. Thanks for that question, Josh. All righty, and just a thank you there from Philip. So thanks, Philip. Appreciate your feedback. Hope you've enjoyed today's session. I'm going to wrap things up there. We've been going an hour. Well done on your questions, and look forward to, or you'll see the video come out probably in about a week's time if you want to go back and review any of the information here. And as I said, if you have feedback, hit me up on dave@squirrel.co.nz. Thanks for your time. Bye.